Welcome. This is the Dragon Portfolio. Today I'm going to present 3 different videos that I think explain why dividend growth investing is the best kind of investing. And at the end, I do think that the charting and the predicted forecasts that Dividendology gives shows that it's by far the best, not only in terms of quality, but also in terms of speed of getting yourself retired early. So right now on the screen is the Dragon Portfolio on M1, which is one thing I use, but most of what I do is on Robinhood, and I just have that there. Basically, I have an M1 account, and that's my kind of full account. And what I'm doing on Robinhood is actually building up a small account and hoping that if I can do it, anyone can do it. Anyway, without further ado, I'm going to let Joseph Carlson take it away.
Everyone would love to have a monster dividend portfolio, one that spits out huge dividends day after day, thousands and thousands of dollars. A portfolio of businesses that produces so much income every single week, every month, that you can live off of it. It completely subsidizes and replaces your active income. Dividends, after all, are passive income. It's money that you make without having to lift a finger. You have to do the initial upfront work, you have to buy the investment, but once you've done that, you're set. You earn passive income via dividend. This is not only what my entire portfolio is centered around, but it's also my ultimate goal, to get to the point where I'm no longer reliant on active work, where working is an opportunity. It's a choice. It's not a requirement. We buy into companies that pay a dividend. This is the first way that we grow a dividend portfolio. And along with number 1 here, I would say that an important step is having a consistent income to begin with. You can't leap over to passive income without having an active income. So you need to have a stable job, you need to have a stable income, and you need to have your budgeting down so that you have money every single week to add to your portfolio. But once you have that money, you need to start putting it to work, and put it to work as soon and as frequent as you can. Step 1, buy companies that pay a dividend that pays you the initial dividend yield. The initial dividend yield is what gets the ball rolling. You have money flowing into your account. For example, in this portfolio, I've earned a total of $21,594 in dividends. These have been growing the entire time that I've been investing. This number always goes up, it never goes down. Companies are always paying me dividends. Step 2 is pretty basic. We reinvest the dividend. Once a company pays you out cash flow, use it to buy other companies that you consider to be high return opportunities. So as you have money flowing in every single week and every month in dividend payments, look through your portfolio and see which ones are offering the best opportunity at it. Then we have number 3, the company growing the dividend over time. So this changes the criteria in which we choose companies to invest in. We don't only want companies that pay a dividend, we want companies that pay a growing dividend. And by growing, I mean growing beyond the rate of inflation. We can take Verizon as a counterexample here. This company does pay a dividend, and the dividend is technically growing. It's been growing by 2.39%, but unfortunately, inflation has been above 2.39%. Even if we were really charitable and said that inflation was only 2%, this dividend is flat. It's really not growing at all. The dividend payment, adjusted for inflation, is the exact same today that it was a decade ago. So while Verizon pays a dividend, it does not pay a growing dividend. On the other hand, every single company within my portfolio, every one of them pays not only a steady dividend, they pay a growing dividend. I can take S&P Global, for example. S&P Global pays a consistent growing dividend, and it has done so for years. And the dividend is growing far above the rate of inflation at 12%. MasterCard pays a very consistent dividend, and it's growing at a very rapid rate, 25% per year. And like I said, this is the same for every company. Intuit, Apple, Microsoft, Vici, Texas Roadhouse, Costco, so on and so forth. All of them pay consistent and growing dividends. And that's step 3. And these are the 3 basic steps of building a monster dividend portfolio. You buy companies that pay a dividend, you reinvest that money from the dividends back into companies that pay dividends, and it grows your dividend income. And then importantly, you try to focus on companies that not only pay a consistent dividend, but they pay a growing dividend far above the rate of inflation. All of these 3 together are really powerful. The compounding effect they have is almost magical. Traditional investing, which is the most popular style of investing, which is putting your money into passive index funds, versus dividend growth investing. To preface this, here's a huge preface, big disclaimer. If you're doing investing at all, you're way ahead of most people. So don't get too strung up on the details. What I'm doing is just giving you my opinion of why I'm choosing a dividend portfolio that is a dividend growth portfolio specifically over the passive index fund. Because if you go most places online, all you're going to be hearing is one side. You're going to be hearing the opinion that passive index investing is the only way to invest, and there's really no other realistic way to do it, which I don't agree with. So I'm going to just be giving you my opinion. So to just take a step back, I wanted to go over and just do a quick recap of each type of investing so you know what I'm actually comparing. First, traditional growth investing, and I'm going to call it traditional growth because when I say dividend growth, it can get confusing. So instead of just calling it growth investing, I'm going to call it traditional growth. So traditional growth investing is a type of investing that focuses on capital appreciation. Capital appreciation is when the share price of a company increases. So you go to any company, and I'll take Netflix. They have their market cap. And with capital appreciation, with growth investing, you're looking to buy it at this market cap and hope that that increases, right? That is the goal of traditional growth investing. And this has been the most popular type of investing for at least the past decade. So since the recession, most people have been putting their money in index funds and watching that grow. And it's done very well. This type of investing has done very well. The only concern I have about it is that we haven't really seen how this massive amounts of money in index funds will perform in a bear market or in another recession, because it's largely been done post the 2009 recession. Now, compare this type of investing where you look for capital appreciation to dividend growth. Dividend growth is different because instead of looking at the price of the share, you're looking at the payment of the dividend. So the growth in dividend growth investing, let me give Dominion Energy. This is one that I just highlighted as one of my 3 conviction picks, I guess was the name of it. But Dominion Energy has a long-standing dividend history. So this is their total dividend history since when they started paying them. And you can see this is the dividend growth. Different than capital appreciation. If I go over here, this is their capital appreciation, right? All over the place. Sometimes it dips down like it did during the recession, dips down right here, dips down right here. Capital appreciation, this is what you'd be looking for with that. Dividend growth, this is what you'd be looking for right here. Now, that is the primary differences. Essentially, the goal with traditional growth is looking for capital appreciation. The goal with dividend growth is looking for an ever-growing income stream. This is income right here. You can see that it's growing. That's what you look for in all of your holdings. You want to buy holdings that they continue to grow your income stream. So huge differences there. Now, if you ever say that you're focusing on dividends or doing dividend growth investing, you're going to hear a lot of the same things. You're going to hear that you should only focus on total return. Nothing else really matters beyond that. Dividends aren't tax efficient. It's basic index investing. Dividend investing, they can cut their dividends, right? You'll hear that the stock price is lowered when a dividend's paid. So what's even the point of it? And you're missing out on great growth companies when you only focus on dividend ones, right? So that is what you're going to be hearing over and over again. I'm going to, instead of go through line by line and address all of those, what I want to do is just point out the reasons I like dividend growth. And I just think that they have a bigger weight. The reasons that I like dividend growth outweigh all those little objections. So the first one is cash flow. Passive income is the name of the game. It's literally the title of my portfolio. What I'm building this portfolio centered around is creating an ever-growing stream of passive income. And why is income important? I believe it's extremely important. I don't like buying something that doesn't provide income because I believe it's similar to just like buying gold. It's like buying something that can go up in value, but in the meantime, it's not doing much for you. And then when it does go up in value, to get anything from it, you have to start chipping away little pieces of that gold and selling it. And that's what I believe it's similar to when you're investing in index funds. They do pay some income, but very, very little. Basically, what you're looking for is a thing that you're buying now to hopefully be worth more later. I do not prefer that at all compared to having a constant and ever-growing stream of income. So take a look at this graph. When I look at this is the most important thing to me. Every single month that my passive income goes up, it's less that I'm dependent on my active income. It means more freedom. It means less dependency on living in the rat race. Now I can look at this and I can start averaging these out like I have quarterly here. When I look and say, on a 3-month basis, I'm earning this much, I can actually literally start to say, hey, my portfolio is generating enough income now that I can have my Comcast bill covered for the rest of my life. That's less dependency on me having to pay for that. Then it gets to the point where I can say, hey, my utilities can be covered for the rest of my life. I want to get to the point where all of my basic necessities are completely covered for the rest of my life. And I can do that through passive income. If you're investing in just index funds, you don't have any kind of indicator for that. It's very difficult to tell how much progress you're actually making and becoming less dependent on your primary income. So passive income is extremely important to me. I like the compounding aspect of it. I like the idea of having an ever-growing stream of income that's different from what I'm constantly working for during the day. There's mathematical reasons, there's psychological reasons, there's a lot of different reasons I prefer cash flow over the more speculative way of investing where you just hope that something increases in value later down the road. So cash flow is reason number one that I prefer my dividend growth portfolio over a basic index investing strategy.
Off of dividends. And it's easy to see why people believe that is the case, as that is what most videos on living off dividends will tell you. Let's look at the classic example we usually see. So when people calculate how to live off of dividends, this is typically how they do it. To start out, they need their monthly cost of living. Let's say in this scenario, it's around $4,000 a month. With 12 months in a year, that means we need $48,000 a year to be able to live off of dividend income. Now let's take a more popular dividend stock such as Johnson & Johnson. Their current share price is $162.60 per share. This gives them a starting dividend yield sitting right at 2.96%. So let's go ahead and plug that in right here, 2.96, and hit enter. And you can see this means the amount we need to invest to be able to live off of dividends is over $1.6 million. Investing that much money for the vast majority of people is simply unrealistic, and it's the reason many people get turned away from dividend investing. But the reality is we don't have to invest that much to live off of dividends. In fact, we can live off of dividends with far less invested than the Johnson & Johnson example we just looked at. To uncover the truth about the lowest amount needed to live off dividends, we'll be jumping into a custom-built financial model designed to uncover how to live off of dividends quickly. If you'd like to download the spreadsheet, you can head over to my Patreon page at the link in the description. The first thing people get wrong when they typically try to see how much they need to live off of dividends is understanding their cost of living, and like we already discussed, understanding inflation. So again, let's assume that our monthly cost of living is currently $4,000 a month. With inflation typically averaging around 2%, we can see this black line now represents our cost of living over a 30-year time period. So at the beginning of our 30-year time period, it's around $4,000 a month, but after 30 years, due to inflation, our cost of living will end up being around $7,250 a month. So again, all these variables, when I zoom out, you can see we can project what our portfolio will look like over a 30-year time period. Now, the first thing I want to do is see what it looks like if we don't reinvest our dividends over this time period. So I'll jump over to this tab. And this black line here, again, is our monthly cost of living. And unfortunately, we can see if we utilize high-yielding investments and don't reinvest our dividends, we don't even come close to being able to live off of dividends at any point over a 30-year time period. In fact, this time, let's take a dividend growth investing approach. So what this means is we're typically going to see higher price growth rates with dividend growth investments. Let's stay somewhat conservative and say we see 7% price growth rate. We'll typically see much higher dividend growth rates with dividend growth. Let's say we see 9% growth, but the dividend yield will also be much lower. So for example, maybe we'll see a 3.5% dividend yield. Now, assuming we're making the same $1,000 monthly contributions, let's first see what the results would be if we don't reinvest our dividends. And if we don't reinvest our dividends, it's pretty clear to see that we're not making very much in dividend income for the first few years, but it does start to spike up by quite a bit in the later years. But regardless, at no point still can we live off of dividend income because our monthly dividends never surpass our monthly cost of living. Let's go ahead and scroll down to the bottom of our 30-year time period and see how much we'd be making in dividend income. We can see we're making almost $6,000 in dividend income, but because our monthly cost of living is now $7,245, we're still not able to live off of dividends. And again, keep in mind, this was from $360,000 of total contributions. But what if we reinvest all of our dividends over that time period? Let's see what would happen. And for the first time out of all the scenarios we've looked at, we can see at a certain point in time, we will be able to live off of our dividend payments because our monthly dividend payments surpasses our cost of living. So let's figure out at what point that happens. If we start to scroll down, we can see it's not after 10 years, it's not after 20 years. But right here, you can see this is where things change. In the 23rd year of dividend growth investing, we would be able to live off of dividends because our monthly dividend payments now surpasses our crazy. This comes all from investing only $283,000 over this time period, which is radically different than having to invest the $1.6 million we saw with the Johnson & Johnson example. This goes to show the power of the compounding effect that takes place when you invest into stocks that increase the amount they pay in dividends every year while also reinvesting your dividends. While most people still believe that high-yielding dividend stocks are the fastest way to live off of dividends, the data is pretty clear that dividend growth investing does provide the fastest way to live off dividends. But there still is one more thing we have to discuss, and that is taxes. It's extremely hard to build an accurate model that includes taxes due to the fact that the amount you pay in taxes on your dividends depends on so many different variables, such as country you live in, the state you live in, whether or not you invest into qualified or unqualified dividends, your income level, your holding period, and whether or not you use tax-advantaged retirement accounts. While this does make it hard to model out the exact amount of additional time and money it will take to live off dividends, it's probably safe to say that it will add an additional 10 to 20% to the total amount of contributions you will need to make. So while that news is slightly discouraging, keep in mind, as your income grows over the years, your contributions to your portfolio should increase as well, which in turn speeds up the process of living off dividends. For example, I'm currently projecting that I'll be able to live off of dividends in about 17 years. If you'd like to
So I hope that all made sense to you. I just wanted to go over the ideas and kind of my takeaway. So you can read ahead if you want. So essentially what you look for in a dividend growth investment stock is fundamental analysis. Please look more into this if you're interested. I'm not an expert. I'm just telling you what I've learned and from all my mistakes. So growing dividend history, beating inflation, that's a big part of it. So because if you're just looking at high yield dividends or dividend stocks in general, there's a lot of them that look okay, but most of them have certain pitfalls. So a lot of them don't have a growing dividend. They have a dividend that stays flat or goes down because essentially the dividend is a representative of their health as a company. So their cash flow, their debt, how much expenses they have, how efficient they are, and how much waste is in the company. So if a company has a lot of waste, and the example given was Verizon earlier, unfortunately, I have nothing against Verizon. I think I actually use Verizon as my internet provider, but they don't have a growing dividend that beats inflation. And the reason why is because they have a lot of costs, they have a lot of debt, and they aren't very efficient compared to the all-star team that we went over. And if you need more information, just click on the link or search for Joseph Carlson in that video that we showed you earlier. The second thing we look at is cash flow year after year increasing, and higher cash flow than debt and expenses. So if you want to skip all the research, you can just look at what Carlson has, but and there's a lot of other people that do the same thing. But the reason I like him so much, and I have looked at a lot of different channels and a lot of different sources, but the reason I like him the most is because he focuses only on all-stars. So there's no, B plus companies. It's all A plus companies. Now, back to the argument, it's essentially about true passive income generation. So you're building an engine that creates income for you because you own all-star companies that produce and produce and produce and grow, and they run efficiently, and they don't have a ton of debt, and that's a much better picture because you're not selling your shares. You're owning your shares forever, and then they are paying you, and you're just getting more shares or you're taking the money out. Traditional investing, which is like gold, where you buy it and then you hold it and hope that it increases. So that could just not happen. Like if you do traditional investing, it might not go up. Now it always has so far, so it probably will, but especially if it's like the S&P 500, so it's pretty stable. But even if it does go up, you still have to chip away at it and use it up. You have to sell your shares to get money out of it. Although the S&P 500 actually does have a dividend. So, but what we're trying to do is we're trying to be better than the S&P 500, since most of those companies don't have dividends, even if they are all-star companies. So to get money out of those companies, you have to sell them. Whereas what I'm trying to build is something that will last forever. Well, not forever, but in terms of the market, that I can hand on to my family and I can use for a long period of time and not just use it up and then, oh no, right? So I also want to build it faster. So I'm trying to do everything faster and have things that are lasting much longer, to build generational wealth. And the second piece of the argument is the charts that Dividendology, which is another YouTube channel that you should definitely check out. But he's a little wider in his criteria, and he has a lot more in his portfolio of like higher yield dividend stuff. So it actually might be more interesting to you if that's what you like, or if that's more attractive to you. But in my opinion, the All-Star team only is kind of the best way to go. But he has a lot of free charts and stuff that you could use. But he shows in his video that I had earlier that dividend growth is literally the fastest way because it's exponential on multiple, like there's multiple layers that add up to becoming exponential. It's not just about market volatility and the growth of companies, although that is the fundamental part of it. It's the dividends on top of that are growing because of the growth. It correlates with the growth, but then also the reinvestment. And if you also contribute and use dollar cost averaging, which is the conduit portion of the system, of the Iron Dragon conduit system. I only laugh because it's so funny. I know it looks kind of silly, but that's just how it sticks in my mind, the name. So it's just the best way to invest in kind of mathematical terms. And then it has all these other benefits. My take, put simply, is all-star team only, dividends only. If it doesn't pay dividends, it's on a watch list maybe because it might in the future, but it's definitely not in the portfolio. I add in main ETFs for diversification and stability, and these two I think are all-stars from what I've seen, what I've heard, and the dividends that they've already paid me, and that's the Schwab SCHD and the VIG, the Vanguard Growth Dividend ETF. So I don't know what the I is, I guess for investment or something, but it's a Vanguard fund. They both have really low expense ratios or expense costs, so you don't have to pay a lot. They're managed funds, so they will fix, like if some big stocks are bad or the companies kind of go south, they'll just take them out, replace them. So it's a managed fund, but the expense ratio, like the amount of money that you have to pay them to own it, is like 0.06%. So the dividend yield is over 2%, or it's over 1% at least. So it's already beating that. And then both of these are growing. From the research I've done, both of these are growing dividends. So the Dragon portfolio then uses those to snowball into an unstoppable monster and can weather storms like the recession, market volatility, war and infectious diseases like COVID, all these things that make the kind of gold idea fluctuate and can even drop the price of gold, where you lose all your money and all your gains are gone because of that. On the other hand, with the Dragon, you're only looking at dividend growth. And so all these companies weather the storms, and they already have. Like, we have the proof from 2008, we have the proof from 2020 that these companies bounce back. And not only do they weather the storm, like they drop a little bit, but the year after they're higher than they were before, higher than ever. So that's why they're all stars, and that's why we are investing in them. And you can track them yourself and try to only have a few and not like 100. But right now I have, I think, 12 or 13 stocks that include ETFs, and it's very much manageable. Now, finally, the options trading side of this, iron condors, for example, are basically how to generate side income that's reliable and low risk. And I'm still building the system. Yeah, I'm still learning, obviously. Still learning and correcting things. And it hasn't been tested enough, so I'm learning a lot, and I'm making episode 8 based on that. So stay tuned. I hope you're learning, or at least tracking what I'm doing, and maybe even enjoying the journey I'm on. And I hope that I can build a system that actually works. I've already tweaked like 100 things since I started this, but I will continue to learn and improve, and I'm really hoping that this can help someone out in the future. So, peace. Have a good one.